right, good morning, everyone. Thanks for joining us for another short interview with some of our fund managers. We are joined today by Matthew Spencer from Orbis Investment Management. They form a part of quite a few of the portfolios, the equity and the multi-asset funds specifically. So Matthew, thanks for joining us. I'm going to jump straight in. I've got about 3 questions that we want to run through. Firstly, Orbis being a pretty valuation and fundamental driven house, can you maybe give us a sense of why investors should choose value, and especially why value investments are attractive in the uncertain markets we're seeing at the moment and these periods of high inflation, etc.?
Yeah, sure. So I think the one important thing to realize about Orbis is that while we do have a value tilt, and we have historically have a value tilt, we are not mandated to invest in value. In fact, there's been many times in our past when actually we've had a growth overweight. So we essentially go into the part of the market where we think there's the greatest opportunity. And I think, one thing Alan Gray always used to say is, he said, always judge a manager by their actions rather than their words. And so, if you had to say, hey, Orbis, what do you think of value versus growth at the moment? You just need to go to our portfolio and have a look at it. And at the moment, we've actually never had a bigger overweight to value than we currently do at the moment. So that really speaks volumes on what we're thinking of value versus growth. And so why is that the case? And if you just look at what's happened since the global financial crisis and a complete collapse in interest rates, that's been a massive tailwind for growth stocks in particular. And the reason for that is, what are growth stocks? Well, they're really promise generators saying, hey, invest in us and we're going to bring you, great revenues into the future. And if interest rates are low and you discount it back at a low interest rate, the current value of those companies would be huge. And so as interest rates go up, it's going to be a massive headwind for growth stocks, and we've seen that in the last year, and a tailwind for value stocks. And I think all the excitements over growth stocks in the last decade and the free money that we've seen kicking around the system, it's not uncommon when you have so much free money that it goes for the new shiny things, and growth stocks are a lot more exciting than value stocks. And so your poor value stocks have become forgotten about and are trading at incredibly enticing valuations. But what's the best thing about them is they're not promise generators, they're cash generators, and they're kicking out a lot of cash. And as interest rates go up, I think that's going to be valued more and more. And so, if you're an investor sitting at home and you've done very well in growth stocks, it's always difficult to rotate out of them and into value stocks. But boy, if there ever was a time to do it, it would have been at the beginning of 2022. But probably the second best time is right now, and that is why we have such a huge overweight to our overweight in value in our portfolios.
Okay, yeah. So maybe moving on from that, one of the biggest headlines what we saw over the past quarter was obviously the mini banking crisis that was happening in the US during March, spilled over into Europe. Now, your portfolios have quite a bit of banking exposure, not specifically to the banks in question or the problem banks necessarily. But what is your view on this sector? Do you think we're heading to a bigger banking crisis or collapse, or do you think we've gone past most of the risks in the sector?
Yeah, so I think that's an excellent question, and the problem with banks is you can never answer that question 100% emphatically, because banking is a confidence game. So even if the system was really healthy, but there's a fatal loss of confidence, and you see runs on banks, then you are going to have a crisis. So I just wanted to sort of take out that insurance policy before I do answer more emphatically. And so just from a purely objective standpoint, and you say, okay, is this another banking crisis of 2008? And you look at where we are with the banks, the answer is no. The banking system is far healthier than it was in 2008. And why is that? Well, unsurprisingly, when your sector causes a massive financial crisis, you're going to get regulators stepping in, and banks have essentially been under the microscope for the last 15 years. And what have regulators been making sure that banks are doing? Well, improving their capital position, getting rid of their shenanigans, and simplifying their balance sheets. So, banks all around the world have gone from where they were in 2008, where you're dealing with a lot of derivative instruments or CDOs or whatnot, and getting more and more esoteric, to coming back to what banks should be doing, far simpler. And so I think the bottom line is that if we do go through some sort of shock to the system, the banks should be in a far better place to absorb that. Okay. However, you saw what you saw in March of this year. A few of the US banks did explode, the regional banks. And I think the first thing to point out is that, yes, we are overweight banks in our portfolio, but 0 US banks and 0 regional banks. And actually, it's an eclectic bunch of Korean banks and Japanese banks, which aren't suffering from the same problems as the US banks. But the most important thing to realize is that if you actually look at what happened to those US banks, it was quite idiosyncratic. In other words, it was a problem with that bank in particular rather than with the banking system. And SVB is the obvious culprit. And if you look what they did, the two fatal mistakes that they made was that all their depositors were startups and venture capitalists, or the vast majority of their depositors were startups and venture capitalists. And all that money that these speculative tech companies had raised, SVB was their bank of choice. SVB gets its money. It's got to invest that money somewhere. Where did it put it? Put it into long-dated bonds, which was an awful thing to do, especially as interest rates were about to go up. And of course, as interest rates go up, what's the asset class that's going to get beaten up the most? It's long-dated bonds. So those long-dated bonds come down and leaves this, this massive hole in the balance sheet. Now, where the depositors come and say, "Hey, I want my money back," SVB needs to sell these long-dated bonds at a heck of a loss. And as soon as the market catches on with that, these venture capitalists all speak to each other. They all want their money back at the same time. And that's a big problem for SVB, essentially rendering it insolvent. And the authorities did the right thing. They stepped in, both the FDIC and the Fed. They created a very generous lending facility, and they guaranteed the deposits. And that was a complete overreaction. But it just goes back to the point that I spoke about originally, that it's a confidence game with banks. And so they really had to come in and overreact and say, "Hey, we are here to stabilize the system." And I think it did the trick. But what certainly didn't help is, on the other side of the pond, Credit Suisse, sort of completely unrelated, going through its own banking crisis, which, for full disclosure, we were invested in Credit Suisse about, 3.5 years ago. And we left because we were worried about the quality of management, and we had seen some questionable behavior, and the controls clearly weren't what they should be. And so it wasn't completely surprising to see what they went through. But when you've had one idiosyncratic event happening in the US, and now all of a sudden another one in Europe, it's not helpful, right? And it really does shake confidence. And this is what surprised us, is just how much two idiosyncratic events could shake the confidence of the system so much. I mean, I think bond yields, the 2-year Treasury fell by more than 0.5%, which essentially measures the panic in the market. And that's more so than the day that Lehman Brothers collapsed in 2008. And more so than the day after 9/11. So you could see, how panicky and how quickly and panicky the market can get. So it was a very long answer, but in short is, from an objective point of view, it's not another 2008, but banks is a confidence game. And so that's why you can never answer the question completely emphatically.
Yeah, okay. Thanks for that, Joe. It's very comprehensive, clears it up well. I think maybe last question from our side. The portfolios, or across your portfolios, you have quite a bit of exposure to emerging markets. And historically, you've also typically held overweight position in these areas or in the sector. What's your view currently on the region, and what drives the conviction into these emerging markets?
Yeah, so I think emerging markets is hugely broad, but the bottom line of what drives the conviction is what always drives our conviction, and that's bottom-up stock picking. So picking the companies apart, really getting to know them, and then determining, if we had all the money in the world, what is the price that we would pay for this business, independent from what it's trading on the market. And when you do that, there's a deeper discount between the emerging market companies, between price and intrinsic value, than there is between the developed markets price and intrinsic value. Now that makes complete sense. There should always be a discount to emerging markets, just given the additional risk you're taking on. But the discount has been deeper than it has been historically over the last decade. And in particular, the US has become very expensive, and that's why we so underweight the US in favor of these emerging market companies. And often the conclusion we would come to is we'd look at an emerging market company and then we compare it to its developed market counterpart, and the company we're seeing in emerging markets was, noticeably better on most metrics and cheaper. And so, hey, why wouldn't you go for that company? But I think it's going to serve us well. But one area that I think we did get wrong is underestimate the geopolitical risks, and particularly in China. And the Chinese companies that we had were fantastic companies, some of the best companies in the world, with great corporate governance, management we were prepared to marry. But this is the risk of investing in a regime where essentially one swipe of Xi Jinping's pen can have significant ramifications. And so I think we've tempered that exposure a little bit, despite those stocks being sort of mouth-wateringly cheap and those companies being fantastic. And so I think in summary, I would say we still, favoring emerging markets over developed markets in a lot of aspects, but maybe a little bit more cognizant of the geopolitical risk.
Okay, yeah. Thanks for that, Matthew. Thanks so much for joining us. That's all the time we have today. We'll see you again next time. Thank you.
Absolutely. Thank you, Evan.
Thanks, Matthew.